Let's run through an example for a shareholder's basis in C Corp stock. Now, calculating an entity owner's basis in C Corp stock for tax purposes involves keeping track of the initial investment, additional capital contributions, and any changes resulting from the corporation's activities, such as retained earnings or distributions. Here's an example to illustrate this. Now, this is very similar to S Corps and to partnerships. There are differences for sure, and we'll go over them when we see those lessons. But what's your basis in your investment? Your investment could be a C Corp, your investment can be an S Corp, your investment could be a partnership, and we'll see how your basis ebbs and flows, increases, decreases based on everything. So let's say that Entity A purchases 10,000 shares of Corp ABC at $10 per share. So your initial basis is just the number of shares times the purchase price per share, which gives you $100,000 of basis. Awesome. Now, additional capital contributions. In year one, we have an additional contribution. We contribute an additional $25,000 to Corp ABC. That gives us now $125,000 of basis. Then the stock basis adjustments. Assume that ABC generates retained earnings of $50,000, which net income goes to retained earnings, and that's in year one. And then they distribute $20,000 as dividends in year two. In year one, Entity A's stock basis remains unchanged. As retained earnings do not affect the stock basis in a C Corp, the stock basis remains at 125. Now, if you're thinking of consolidations from the financial exam, we've got the equity method, fair value method, and the consolidation method. This is why we definitely recommend not taking those exams back to back, because you'll see differences in the treatment of something such as that. But definitely want an exam in between those to kind of reset your mind. In year two, dividends received by Entity A are not included in the stock basis calculation for a C Corp. Since Entity A received $20,000 in dividends, there's no impact on the stock basis, and as such, it would remain at 125. Now, let's see what happens with those dividends. Let's say that Entity A receives the dividends, pays tax on them, and maybe after tax, they've got $15,000 left from cash from those dividends. If Entity A decides to reinvest that money, then that would, of course, increase the basis in the stock. The final stock basis here is going to remain unchanged from that initial 125 we had from the additional capital contribution. So we got 125. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.